Welcome everyone to another episode. Um, my name is Bastian. For those of you who don't know me, I know I've sent the link out to a couple of spots, and so I want to go ahead and introduce myself. For those of you who are catching me in the recording or on YouTube, my name is Bastian. A lot of you guys may know me as Honcho Mindset, and today I want to present to you guys my understanding of liquidity. Okay, these are concepts and beliefs that I've acquired through my experiences and years of trading. And so none of this is, I guess you could say, all of this is hypothetical, right? These are just my understanding of the market and how I perceive the information. And so I invite every single one of you that's watching, whether you're live or on the recording, to challenge everything that I would show you today. Please take advantage of this information and challenge it. Backtest this info. When you're out trading, I want you guys to really backtest this information. The only time that I truly find myself backtesting is whenever I come across new concepts, new information that I'd like to challenge against live market data. So let's go ahead and dive into it. All right, guys. So as you guys know, as institutional traders, we like to see price mitigate. Okay. So the definition of mitigation is to reduce risk or to lessen the pain or loss, right? To mitigate the risk, to mitigate the loss, or to lessen the loss that is about to occur, right? Or could potentially occur, to lessen the risk, right? So when you mitigate, and I want you guys to really understand what mitigation is. When we're looking at the market, mitigation, all we want to see is price action. For example, when it's bullish, we want to see one candle just push down, take out liquidity or take out previous lows, okay, and move price action the opposite direction. All right, when price action moves the opposite direction, that candle that essentially shifted structure and swept major liquidity, we want to see those areas played back into, right? So you guys can see we trade down, we push the market structure up, we essentially break structure to the upside, and you guys can see that candle, we come back, we trade above it, we come back down to it, mitigate, right? And so what they do is they come back just to take out orders and move price action the other way. Now, you guys will really understand why they have to do this today, okay? So the way I'm going to explain this to you guys is I'm going to break it down to you guys with a broker, right? So we all have brokers. Those of us who trade live, we have brokers. Even the individuals that trade demo, you guys also have brokers, okay? So let's go. All right, so now these brokers, all right, we're going to draw a couple of things on here. Okay, so we're going to call, let's see, us and the world, I guess the world, right, would be the markets right here. Okay, the markets right here. We'll leave that right there. And then our broker, we're going to actually put our broker as our liquidity provider, right? So our broker provides the liquidity for us, the service. And the reason that we need a broker, us as a single entity, or retail traders as we like to call ourselves, is because as retail traders, we're not allowed to engage directly, okay? We're not allowed to engage directly into the market, okay? As market retail traders, we are not allowed to trade right into the market. Why? Because liquidity would just swallow you up, right? Liquidity and volatility are so big and large and vast that it would just swallow you up, right? And so what we are required right? What is necessary to day trade essentially is a middleman, which we refer to as the broker. That's why most of us either trade with a prop firm and the prop firm deals with the broker, or we trade with the broker directly. Okay. So given that we go from the broker, and essentially, and I want you guys all to understand this very clearly, you are not ever trading with the market directly. If you're trading with a broker, there's not a random ass person on the other side of your trade. The broker decides all that. Okay. The broker actually, if you're buying, the broker is the one that sells the position to you. Right? You can't just buy it out of thin air, right? We are provided the opposite side of that trade by the broker. And then essentially, right, vice versa. If you're selling back to the market, the broker is the one selling or buying the position back from you. Right? So we go back and forth between from us to the broker, to the market, and then back to the broker, and then the broker back to us. Okay. So we don't ever directly exchange with the market. Broker takes care of all of that. Okay. So now, with that said, these entities, what we like to call them, these, instead of having an individual person there, what we have are these entities, these penguins, what we like to call them, right? These institutions, central banks, right? These entities, what they do is they cannot trade with a broker, because most of these entities, they are much bigger. Okay, they are much bigger than any of these liquidity providers that are out there, right? So for most of us, we'll never be trading in this aspect, because most of us will stay within the broker unless we become our own broker and so forth, right? If that's your goal, that's badass. But essentially, the only individuals that will trade against the market itself is these big institutions, hedge funds, brokerage. And so these guys, central banks, are the ones actually taking trades with the market. Now, these guys have a ton of liquidity, have a lot of equity to be moving in and out and through the market. Okay. And so who are these guys? These guys are the whales. These guys are like JP Morgan, Citibank, like all these huge institutions that are international. All right. And so essentially what these guys can't trade with brokers. And so when they trade differently. So what happens is they trade directly with the market. Now, as I mentioned earlier, you can't just buy the market up. They can't just say press buy right here and then just buy the market up. Okay, it doesn't work like that. They can't just press one button and move the whole entire market. Okay, what they do, or what they're required to do, is if they are buying, they have to find a willing seller, okay, for their longs. This part's important. So if you guys are taking notes, this is the part where that I'd write down. Institutions cannot straight up buy or sell anywhere in the market. They have to find willing buyers for their sell positions and willing sellers for their buying positions. Okay? So essentially, when you guys see these big market moves, what these actually are is these penguins, or these entities, what they're doing here is they're dropping a sell order right there. And in the same area, simultaneously, they are also dropping buying orders. So we're going to put our buys as our long positions right there. Okay. So guys, what happens at this level, and we're going to mark out this level, which is 95,739. Okay. What they're doing at 95,730, right? Or we'll call it 95,740 for study purposes. What they're doing at 95,740 is they're not just dropping a short position, and that's why the market created this big bearish candle. What they do, guys, is they actually trade with the market environments, go with the market flow, market structure, market liquidity. Okay. And they position themselves in areas where liquidity has been taken and can be potentially offered. That's important. Not just taken, but offered. And I'll show you guys what that means. Okay. So when they buy, they have to sell because they have to find willing buyers for their sellers and willing sellers for their buyers. This is law. They have to do this. So you may wonder, how can they make money if they're just hedging the market? Right? And so what these guys do, what they do is they understand liquidity. My belief of the market is that it is liquidity engineered. Okay? The market, it is my belief that it is liquidity engineered. Write that down. And I want you to challenge that belief. Okay? Until it's proven incorrect or correct by you, right? By your own experience. And so when they buy, they have to sell. And when they sell, they have to buy. And the way that they do these things, guys, okay, is, and I want you guys to first understand what is liquidity. Liquidity are not just equal highs, how most people are taught, and equal lows. Liquidity are any highs and any lows that are formed. There are four major types of liquidity. Okay. There are four major types of liquidity, and I will go over them later on in this video. And I want you guys to understand this. Liquidity is not just equal highs and equal lows. It is any high and any low. I will show you guys how to identify these as we move forward. But for now, for study purposes, I want you guys to understand any high and any low holds liquidity, specifically on your higher time frames, daily and above. Those are your most liquidity building time frames. Okay. Those are key time frames, to be precise, to find your liquidity. Your liquidity will more than likely be found daily and above. Okay. As a day trader, I promise you that's what you would want to see them at or identify them on. All right. So with that said, now guys, I'm going to walk you through this process of how liquidity is moved. All right. And so liquidity are large pockets of money or pools of money. Okay. Liquidity doesn't necessarily mean equal highs and equal lows. It can be any high, any low, and any time frame. My favorite time frames are the higher time frames, daily, weekly, and monthly, and anything in between those. Okay. And so when my belief is that below every single low, there are stop losses. And I'm going to write this down for you guys in the corner. Okay. So liquidity types, okay? These are liquidity types. And these liquidity types are stop losses, resting above highs, resting below or above highs and lows, okay? And they're not just stop losses that are resting below highs and lows. I want you guys to be very clear on that. It's not just stop losses. It is also buy stops. And we'll do this. Yeah, buy stops, sell stops. And what are sell stops? Okay. Sell stops is when people set a limit underneath a low and they anticipate price action that's above it to just trade through and continue. Okay. So what they do is they put sell stops, entry right there, stop loss down here, give it enough room, and they usually get traded through. That's liquidity. Okay. So sell stops and buy stops. They also have buy limits and sell limits. Okay. They also have buy limits and sell limits. Guys, these are everywhere. And so, and lastly, we'll put right here, lastly, limits. Okay. So with that, are resting below the lows. So with that, guys, I want you guys to understand, okay, because stop losses, buy stops, sell stops, and limits are less resting above and below all the lows, these are levels of liquidity. And so you, as a trader, your goal is to identify which one of those highs and lows has more liquidity or has a higher probability of having institutional liquidity there or being targeted by these institutions. That's how these institutions trade. Why? Because what happens to your order, okay? I want you guys to follow with me here. You have, let's say, your stop loss right here. Price action is trading close to it. So price action is trading close to it. Then price action, you're, let's say, in a sell from right here. Boom. You're in a short position from like right there at that level. Boom. Stop loss right above it. Okay. Price action, what happens when it moves and hits your stop loss? What happens to that sell order is that when you're trading with your broker and you're in a sell position and that order closes, whether it closes manually, whether it closes with a stop loss, whether it closes with a take profit, what happens at the moment of the closure of that sell position, you are selling back your position to the market or to your broker, meaning that your broker is buying back your position. When that sell order closes, whether it's in profit, break even, or as a loss, it is being closed, okay, with buyers taking that position. There's always an opposite side to every single trade. And trades happen when you open and close them. Okay? There's two trades that happen for every position. A buy and a sell or a sell and a buy. Always. Always, always, always. The trade will either start in a buy and end in a sell, or start in a sell and end in a buy. No matter what, how that trade closes, this is how positions work. So with that said, if I'm looking at the lows and I'm saying any lows are potentially just liquidity and stop losses resting below those lows, buy stops resting below those lows. Let's say right here is the stop loss, full stop losses. Right here below that candle, those are stop losses. Okay. And so what's happening, guys, what's happening here is that when price action trades through them, all of these guys, now that we show the sell example, all of these guys that bought in here and put their stop losses below the low, bought in here and put their stop losses below the low. All of their buying, okay, gets turned into a sell, right? And if I want to buy as an institution, if I want to buy lower, I have to find what? Willing sellers for my buys. This is important, guys. I want you guys to really get this down. If I am a buyer, if I want to sell the market down and I'm pushing the market down, I need to find willing buyers, right, for my sells. And if I'm buying the market up, you got to think as a penguin. We're the big institutions, okay? We're the big institutions. We're no longer the little fish and the little shrimp in the ocean now. We're the whales, right? So as an institution, think as an institution. If I want to buy in the market, I have to find willing sellers for all my buying positions. If a buy order turns into a sell when it gets stopped out or when it gets closed, where are the willing sellers for the buying that's going to take place all in here and push this market up? Where are the willing sellers for these buys? Where are they at? It's all the people that bought early here, and market came down, closed all their buys, and turned all of that into sells. And because now all of those buying orders turn into sells, they are my willing buyer. They're my willing sellers to my buys. Okay? They are all these guys right here. This guy, everybody that bought in Monday, November 29th, Monday, November 8th, all those people that set their stop losses below those lows are now my sellers, my willing sellers to all my buying momentum. This is why I believe the market is liquidity engineered, because these buys cannot happen without all these early buyers, because all these early buyers, their stop losses, their orders being closed out are my willing sellers. They have to sell back their position when that order's closed. That's why, as an institution, when I buy, I want to buy lower than the guy that bought, the institution that bought November 29th, November 8th, right? November 8th right here, November 15th, right? We want to buy lower than all these guys. When I have, this is the next important area. When I have willing sellers for all my buying momentum, okay, when I get all the willing sellers for my buys, I will have enough momentum to push the market to the upside. And with everyone's willing sells, I am able to push market structure up with my buying. Because as an entity, there's no brokers. I have to find my own liquidity. I have to find my own opposite side of the trade. Okay? So I want you guys to look at every single candle. And to start it off, just look at every daily, weekly, and monthly. Start there. Start your liquidity journey there. Start your liquidity understanding there. Set targets. Look at how price action moves. Okay? How many programs do you guys think are out there that what they do is they sell these programs, these algorithms and all this stuff that there's people out there that invest, trade, and never touch or look at a chart ever. You guys got to understand, there's so much money out there. There's so much liquidity out there. It is unimaginable how much money there actually is out there. Right? With so much poverty in the world, you would think like there's not enough to go around. But guys, there's plentiful and more than enough to go around. There's individuals, entities, banks, hedge funds, institutions, and these guys have programs, artificial intelligence, that when price drops a certain amount, they buy. They're not like us that are day traders. These are people that are in it for years, months, decades, that set systems that as soon as the market drops a certain percentage, they're going to buy and put their stop loss. If we're buying, where are we putting our stop losses? At the lows. So these systems, what they do is, how many people know this term? And it's very well known. Buy low and sell high. It is a very well known statement. It is very simple, but many people cannot understand the simplicity behind it. All it means is that there's individuals out there that are consistently buying the bottoms and setting their liquidity or their limit or their threshold at the lows. Right? And so that's why when you're bullish, when you're in a bullish price action, you will have down days, right? You have all these down days here. That entire push down, okay? And we're going to cover the wicks as well. And notice 1, 2, 3 days of bearishness, and before we blast price action to the upside, what do? We take out the lows. Why? Because these institutions need willing sellers. Everybody that bought here and this day, November 13th, and set their stop loss right below the low, all of these systems, these artificial intelligence, these AIs that are, these systems that are here investing people's equity, are getting stopped out, right? Why? Because they don't want yesterday's buyers to profit from today, but they want yesterday's buyers to provide the liquidity for today. You see, yesterday's buyers, and why do people keep doing it? You may ask, like, why do people keep investing then? Why do those systems exist? And the simple reality is because not always does this happen. Okay? What happens is they provide them with down days, stop them out, then another down day, and they'll give them a little bit, right, to get with. They'll give them some profits. Right? And that's what truly keeps that dopamine of profits, truly keeps individuals, these markets, these institutions, these hedge funds, all of these liquidity entities coming back. Why? Because there is potential gains in this game, no matter which way you put it. Okay. So liquidity, guys, the reason we run lows, the reason we run highs is because there are stop losses, sell stops, and buy stops resting above and below those areas. So when you understand liquidity, let's go back to the weekly. When you understand liquidity, then you have to say, okay, for these guys to be able to close their orders, they're buying orders now. So now these whales have to close out their buying orders, right? All the buys that they put here, they have to find willing sellers for willing buyers for all their sells. Willing buyers for all their sells, because when you close a buying position, you can only close it. The opposite side of the trade has to be taken by somewhere or someone. And so where do we find these individuals? A lot of these institutions will just buy back their own positions, and they'll just go back and forth between that system. But the reason that they are profitable, they can't just always be hedging the market. The reason that they are profitable is because they understand that's what's resting above the highs. Now we're going with the opposite side, right? What's resting above the highs are sellers, right? There's these smaller entities that are selling, and there's a lot of them. There's a lot of systems that when the price goes up, they'll sell a certain amount and rest their stop losses where? Above the highs. There's a lot of systems that are, once it reaches a certain area, they activate buys, right? These are buy stops. So once these breakout traders, right? These breakout traders that use these trades that once it breaks out to the upside, we're going to buy right here, right? We're going to buy right there where price broke out. And so what's going to rest there? Willing buyers. Okay. What am I trying to do? I'm a penguin. Remember, I'm a big entity right here. What am I trying to do here? If I'm buying, when I close my order, I have to sell back all of that liquidity. Who am I selling it back to? Who am I selling this all back to? All the buy stops, all the people all the breakout traders that have buy limits right here. Here are some willing buyers. Everybody that sold right here, when their stop losses get hit, what do their orders do? Turn into buying momentum, right? And so you got buyers who are sell stops, whose sell stop losses are getting hit, and you have buyers whose buy stops are getting triggered. Liquidity is found above the highs and the lows. No matter how you look at it, we will find willing buyers for their sellers and willing sellers for their buyers. That's how they move the market. They find above these highs and below the lows liquidity, enough willing buyers to their sellers. And so what if they have to buy back? Because when they're selling, when they're buying here, they're closing their trades. And to close their trades, they have to have a willing seller or willing buyer to sell back their position to. Because when you close a buy, you're selling back your position. When you're buying, okay, you are, the moment you close it, you are selling back your position. We have brokers to handle all of this headache, right? We have brokers to handle all of these headaches. These institutions do not have brokers to handle all of this. They have to move the market this way because they have to find willing buyers for their sells and willing sellers for their buys. That's why, guys, you guys always see things like this. Why do you guys think you see stuff like this? We just come right below everything. Right below weeks and weeks of price action. Right? We come below Monday, March. Yeah. March. Right here, the week of March 7th. And we go 1, 2, 3, 4 weeks of liquidity. Meaning there was 4 weeks of people setting stop losses below these lows. Then you have what? You have your breakout traders. What do these breakout traders do? They want to see sell stops here. So the breakout traders, they want to see out of these equal lows. Sorry, 1 second. Out of these equal lows, they want to see price action trade through and keep going. So what do they set there? The breakout traders, they set a sell stop. And then what do the willing buyers do when they're buying right here? They set their stop losses below the low. So now you got willing sell stops, who are the sellers who are just going to sell down or try to sell down the breakout. And then you have all these sellers, right, whose stop losses are resting right below the low. Why? Because people that are buying, when they get stopped out, that buy turns into a what? A sell. Therefore, my willing seller to all my buying momentum. There are two sides to every single setup, to every single trade. That's why you guys see things like this. The market is liquidity engineered. Okay? When they sell down, they're not just selling down because they need to, because they are looking for liquidity, pure and simple. Once liquidity is taken on one end, right? So now they want to buy at this liquidity level, which is 97,700. Okay. We'll look at that level as our liquidity level, right? We're going to find stop losses, sell stops, those breakout traders, and stop losses for all the buyers. So once the stop losses get hit, those buys turn into sells. And once those breakout limits get triggered, those sells get triggered as well, right? So those sellers that are trying to trade that breakout are my willing sellers for all the buying momentum that I'm putting in right here. They are my willing buyers. They are my willing sellers for my buys. All I'm doing here is buying. And all they are here, all these lows are, is my liquidity for my buys. Now, towards the end of this video, I'm going to show you guys a lot of examples of how to apply this. Okay, so now these willing buyers have to find what? They have to find willing sellers, right? They have to sell back. These buyers have to sell back their position. How do you sell back? They have to find willing, those sells have to have willing buyers. They can't just sell back their position to anybody. They have to sell it to somebody who's willing to buy it. And if they're not willing to buy it, then they're going to force their stop losses. They're going to run the stops. They're going to run the highs. They're going to sweep them and run them. There's two ways to take liquidity. A sweep of liquidity, which just takes the low or the high and goes the opposite direction, or they're going to run on liquidity. We're going to get a run on liquidity. A run on liquidity is when we take, for example, the high and just continue trading through it. The market is liquidity engineered, guys. All these willing buyers found they're willing to sell back their position to the market, had their willing sellers or their willing buyers right here. Why? Because everybody that sold and set their stop loss right above this high, everybody that sold at this high, at this high, at this high, and at this high, put their stop losses right here, right above this line right here, right above 420. Okay. And when a selling order gets hit and closes, it is forced to buy back its position. What are the breakouts traders doing? They're setting buy orders right there. So when it trades up, they buy the price that breaks out. Who are my willing buyers? These guys. The stop losses and the breakout traders. They are the willing buyers when I close out my trade and sell back my position. Okay? I want that to be very clear to everyone. All right? So I'm going to show you guys a bunch of examples, right? And I want you guys, before we dive into that, I want you guys to understand that there are 4 liquidity types. There's 5. Number 1, previous monthly highs and previous monthly lows. A lot of you already may know these. Number 2, previous weekly highs and previous weekly lows. Number 3, previous daily highs and previous daily lows. Number 4, Asian highs and Asian lows. Okay? And the Asian highs and Asian lows will actually put them, we're going to call number 4, these are the intraday liquidity. And you guys will see in a second why I'm naming it this. And this is the intraday liquidity. Okay, and intraday liquidity has a few variety. Okay, so it's Asian highs and Asian lows, and then 1 hour highs and lows. 1 hour highs and lows. So we have the intraday time frame consists of Asian highs and Asian lows and 1 hour highs and 1 hour lows. That's intraday liquidity. And now the last form of liquidity is internal and external liquidity. Okay, and internal and external liquidity are applicable to any of these time frames. Okay, so internal and external liquidity are applicable to any time frame. So internal and external liquidity will be any of these liquidity types right here. The extra confirmation is when it's internal and external liquidity. That's your extra confirmation. These are the liquidity types. And when they land or align with internal and external liquidity confirmations, then they become an extra. It is an added confirmation, a supporting confirmation to your bias. Okay? I'm going to leave this up so some of you can take notes. All right. And so what we're going to do next actually is we're going to really dive deep. Okay. We're going to dive super, super deep into examples and how I utilized this on my day-to-day trading. So I'm a day trader. So this is the knowledge and experience that I've been able to acquire to apply these concepts. And so this is what we're going to dive into for the next hour or so. We're going to dive really deep into this, and we're going to continue to apply this.